As of 12:47 p.m. Eastern Time on October 30, 2025, BigBear.ai Holdings, ticker BBAI, is trading at $6.83 per share. That is down about 1.01% for the session, or a drop of 7 cents. The stock has been volatile today, opening lower at $6.69 before pushing to a high of $6.84, all on extremely heavy volume that has already surpassed 37 million shares. This is a name that defines the current market's appetite for high-concept AI stories, but it's also a name where the story and the financial statements are in a direct conflict. The immediate data point that jumps out isn't just the price, but the fact that a stock this volatile with such a heavy retail following is trading with a short borrow fee rate of less than 1%. For a stock many believe is a prime candidate for a massive squeeze, the cost to bet against it is almost zero. This suggests the professional market sees an abundance of shares available to borrow and that the narrative popular online may not match the mechanics of the market. This is the central tension of BBAI. The expectation, the story you see pushed across social media and forums, is that this is the next Palantir. It's a small-cap company sitting at the intersection of two of the biggest themes imaginable: artificial intelligence and national defense. The company wins high-profile contracts, like its recent partnership with T-Second to deliver AI-enabled edge infrastructure for the battlefield, or its work supporting the U.S. Navy's UNITAS maritime exercises. These headlines paint a picture of exponential growth, of a small company embedding its technology deep within the U.S. government's most critical operations. This narrative is what fueled the stock's incredible 80% rise earlier this year, pushing it from under $2 to a recent high over $9 just a couple of weeks ago. The expectation is that you are getting in on the ground floor of a future defense tech giant. Then there is the reality, which is found in the company's financial filings. This is what the bears and that significant short interest are focused on. When BigBear.ai last reported earnings for the second quarter back in August, the numbers were not just a miss, they were alarming. Revenue didn't grow. It fell, dropping 18% year over year to $32.5 million. The company posted a staggering net loss of $228.6 million, though much of that was due to non-cash charges. More importantly, the company's management did something that almost always signals deep trouble. They completely withdrew their full-year adjusted EBITDA guidance. They also slashed their full-year revenue projections significantly, from a high of around $155 million down to a range of $125 to $140 million. This isn't a slowdown, it's a reversal. The bull case points to the company's $380 million backlog, but the bear case points out that the company is clearly struggling to convert that backlog into actual profitable revenue. This conflict is what defines the daily trading action. The stock is not trading on its earnings per share. It's trading on narrative, momentum, and an enormous amount of speculative volume. The recent spike to $9.39 in mid-October was a direct result of the T-Second partnership news. It was a classic buy-the-rumor event. The subsequent pullback to today's $6.83 level is the market digesting that news and realizing it doesn't change the immediate financial picture. The stock has a beta over 3, meaning it is exceptionally volatile. It's a trader's dream and a long-term investor's headache. We are now in a holding pattern, with the next major catalyst being the upcoming third-quarter earnings report, which is scheduled for November 10th. That day will be a moment of truth, where the narrative of new contracts will either be validated by improving revenue or shattered by another quarter of decline. Now, let's talk about the significant short position, because it's a core part of this stock story. According to the most recent official data from the NYSE, about 17.74% of BBAI's entire float is sold short. That is objectively high. Over 76 million shares are being held by traders who are betting the price will go down. This is where the retail narrative of a massive short squeeze originates. The expectation is that if the stock gets a piece of good news, like another contract or a surprise earnings beat, all 76 million of those short shares will be forced to buy back, launching the stock into the stratosphere. However, the reality of the data suggests this is highly unlikely. The key metric isn't just the short interest, it's the days to cover. BBAI's days to cover is currently just 0.31. Because the stock trades with such incredible volume, today's 37 million shares is not a wild anomaly. The 30-day average is well over 150 million. A short seller isn't trapped. They can cover their entire position in a matter of hours, not days. This is why the borrow fee is so low. The borrow fee is the interest rate shorts have to pay to borrow the stock. For a hard-to-borrow stock that's truly on the verge of a squeeze, this rate can spike to 50%, 100%, or even over 300%. BBAI's borrow fee is languishing around 0.71%. This tells us that the major institutions and market makers, firms like Citadel, Susquehanna, and Jump Financial, who all show large positions in their 13F filings, have plenty of shares available to lend. They are happily collecting the premiums from the massive options volume and lending shares to shorts, playing both sides of this volatility. For any investor, this is actionable information. You can find this data on platforms like Fintel or Ortex, which track borrow rates in real time. You can find the official short interest on the NYSE or FINRA websites. When you see a low borrow fee and a low days to cover ratio, it should be a major warning sign that the squeeze narrative is likely just wishful thinking. What's your take on that 17.74% short interest? Is it smart money betting against the valuation, or is it just market makers hedging this extreme volatility? It's also worth noting the off-exchange activity. FINRA data consistently shows that over 40% of BBAI's trading volume, including a large portion of short sales, occurs off-exchange in dark pools. This means a significant amount of the selling pressure isn't even visible on the public lit exchange, which can contribute to price suppression and make it harder for the stock to gain upward momentum. We also saw spikes in fails to deliver back in late September, where millions of shares worth of trades failed to settle. While this has since subsided, it points to a period of intense, perhaps irregular shorting activity that likely contributed to the volatility we saw in October. So, what does this company actually do to attract this much attention? BigBear.ai describes itself as a provider of mission-ready AI solutions. It's not a consumer-facing company. Its primary clients are in the U.S. national security and defense sectors. Its main products include Conductor OS, which is a platform designed to manage and orchestrate different AI models, and Veriscan, which is a facial recognition and biometric system that you might see used at airports for identity verification. They also have tools for computer vision and data analysis. The idea is to give defense and intelligence agencies the ability to make faster decisions by analyzing massive amounts of data in real time. The appeal is obvious. The Pentagon has a budget of hundreds of billions of dollars, and a growing portion is being allocated to disruptive technology. BBAI is positioned to capture a piece of that. But its financials show it's still operating more like a government contractor, building lower-margin, custom one-off projects rather than a high-margin, scalable software-as-a-service company like Palantir. Looking ahead, the entire market for BBAI is coiled around that November 10th earnings date. The expectation is that the recent string of positive press releases, from the T-Second partnership to the Navy exercise, must be translating into a better outlook. The reality is that the company's management was so uncertain about their business just 3 months ago that they pulled their guidance. This creates an incredibly binary setup. If BBAI beats estimates and, most importantly, raises its full-year revenue guidance, it would directly challenge the bear thesis. It would prove they can convert that backlog. This would hurt the 17.74% short interest and could cause a significant rally. However, if they miss again, if revenue is flat or down, and if they fail to reinstate positive guidance, it will confirm the bear's entire case. It will signal that the backlog is not converting, that the business model is struggling, and that the stock's valuation is built entirely on hope. In that scenario, the $6 analyst price targets that currently look like old news could suddenly become the next stop down. The heavy volume we see today is the market making its bets on which of these two outcomes will occur. With earnings coming up on November